So, hi and welcome to Fuel Podcast. My name is Elena Musko. I'm CEO and co-founder of Fuel Finance. And at Fuel Finance, we provide cloud financial department and we make finance fun for founders. And today, our guest is John from Sendbird. And Sendbird is number one conversation platform for mobile apps, powering more than 300 million people on a monthly basis, backed by YC, by Tiger Capital, by Softbank. And we are also very proud to have you, John, as an investor. Hi, John, and thanks for joining us as our first guest in our Fuel podcast.
Yeah,
And as we're here to talk about financials, let me start from the first question. So, not usual question, how are you, but very financial question. How is your runway and EBITDA margin?
that's a wonderful question. I think we're doing okay from that front. Thankfully, we met some very generous and long-term investors who were able to give us ample fund to be able to really build an enduring company. So from that perspective, I think we have a relatively strong and healthy runway.
Cool. In some interviews, you mentioned that your runway was more than 70 years or something like that, or something like 70 or 80 years. How
Yeah,
is your thing now with your
I
runway?
think we're probably a little bit more shorter than 70, 80 years nowadays because we've been investing a lot into R&D, also investing quite aggressively into marketing sales. Although with the current market, we have probably dialed back a little bit. I think overall we're still aiming for a healthy and faster growth. So from that angle, we're probably a little bit less than 70 years. Yes.
Let's start from short description of your business model, so to understand more deep your financials. Because as I understand, your business model is platform as a service. It's a little bit different from basic SaaS model. But how can you explain this type of business model, and especially how is unit economics different in Sandbird from like basic SaaS model?
Yeah, I think just abstract wise, probably I wouldn't consider it as a too different, but a lot of so-called SaaS applications are usually like seat driven on a subscription
Mhm.
basis. So pay basically how many people are using your software on a monthly basis. Then you commit to some annual amount, and you'll probably pay on a monthly or annual basis. That's mostly how a lot of software solutions are built. Nowadays, a lot of that business model have diverged a lot more. More and more softwares are switching over to what they call the consumption-based or usage-based pricing models. But from Sendbird perspective, we've always been more of a usage-based pricing model. Basically, how many people are having conversation through our platform on a monthly basis, and then customers can buy in bulk and pay annual upfront or pay on a monthly basis, and then kind of have a committed amount of using our solution. But it's not tied to, let's say, employee headcount, but it's more to do with the actual user volume. So from that angle, slightly different, but from the kind of unit economics, but I think a lot more B2B SaaS company will use something like gross margins, right? So from our perspective, we are a very infrastructure heavy company. So the top so-called SaaS companies who are, let's say, an HR solution or whatnot, productivity solution may have 80%, 90%, sometimes 95% gross margins. We're a little bit lower than that. So, but overall, compared to other more infrastructure heavy companies, I do think we try to maintain a relatively good, healthy gross margin. On the lower end, probably I've seen B2B or PaaS, platform as a service company go down to as low as 40%, sometimes in the mid 50s. And then some of the companies who are very aggressively growing and giving steep discounts to customers to gain more market share and steal the market share away from competitors may go down temporarily to even 30%. But I think in general, public markets will penalize those companies pretty heavily. So you probably want to retain somewhere above, call it 60, 70% in gross margin to be able to build an enduring company.
So it's like this support part in COGS, like in cost of goods sold. So it's higher because of it's much more like you provide much more services to support your customers in comparison with SaaS model. Am I right?
We're infrastructure heavy, so meaning basically we just have a lot more cloud costs. So we pay a
Mm,
lot to our cloud service providers, whether it be AWS and things like that. So that's where a lot of our server costs will go to. And you'll probably find this in a lot of data heavy companies, also AI companies where there's a lot of compute cost, then the gross margin tend to be lower. And then again, when you have a software that's simply productivity software that you use on a website that doesn't require a lot of like data transaction, because when employees are using it basically on a seat basis, people don't tend to use a lot of data. Versus if you are serving a mass consumer product, then there will be a lot more server costs associated. So you can kind of think it through that lens.
Sounds interesting. And talking about before, like all other financial parts, it will be interesting to hear from you. How can you describe yourself as a CEO? Because I see from many companies that this part is also important, and how do you manage your finance is very like connected with sales CEO style of management.
Yeah, I think there are a couple of different ways to answer this. I mean, personally, we have 4 family core values. Our core value number 1 is positive tenacity. I actually wear this bracelet all the time to remind myself to be, to be an optimist and always be tenacious until you hit your goal. So to never give up. So I consider myself as a very positive and tenacious CEO. But if you think through a more kind of like a useful framework, it would be things like big 5 factor models or Myers-Briggs, whatever personality kind of assessment that you can use. I'm probably more higher in the conscientiousness. Not probably, I measured it. So high in conscientiousness, meaning I'm more orderly. I tend to organize things a lot more. So I'm more of a spreadsheet CEO, also an investor. So I like to put things into structures and measure the data and hopefully measure in granularity a lot more often than most people would do. So that's kind of like the CEO profile of me is more orderly, more structured. So if you're to use something like Myers-Briggs, I'm an ENTJ, so kind of intuition driven, logical, but very structured and detail oriented.
Yeah, I was very surprised when you asked me to make this test. So it's also very interesting. So trying to structure your team with some type of analytics, because all these tests, and this specific test also about analytics.
Yeah. And speaking of finance, if you don't mind me adding, our CFO is ESTJ, and I love him for it because I really enjoy working with the STJ types when it comes to like data and like finance, because obviously those types tend to be a lot more data driven, very rigorous when it comes to execution, very structured and organized, exactly what you want when it comes to finance.
Yes,
So
especially
that's
with finance.
yeah.
Yeah, it's cool. And talking about your financial side, so in one of the interviews, you mentioned that you have built internally this Sendbird dashboard, and it's very interesting. So, what periods of time you needed? Like, how many mistakes before, and how much time you spent to build this internal financial system and dashboard?
Yeah. Well, our dashboard is a little bit more around our operating metrics, generally around product usage, our customers like subscription management and things like that. But now we have evolved a little bit after that. Now we use like Looker for our internal dashboard. Obviously, we use CRMs like Salesforce, all of that tied into, I believe, NetSuite. So we use a combination of different software, but a lot of those gluing things together are still built by our internal solution. Generally, if starting out, you probably a startup may not have all the relevant like data sources. Everything will be manual and stuck in the legacy databases. So it'll be very hard to bring that out and integrate into other sophisticated kind of data platforms. I do think nowadays there's a lot more better softwares out there where it makes those things easier, and then also being able to build internal tools a lot more easier. But back when we started, a lot of those SaaS startups didn't exist, so we had to kind of build from scratch. We tried to use what was some of the software that were available in the market back then, but a lot of them weren't like as easy to use or customizable. So we had to kind of scrape it. We had so many like tries of trying to adopt the software, then failed, tried another software, then failed. The person left the company, so nobody wanted to own it. So we had to go back to our roots and try to build it internally. There's just so much frustration trying to like get those metrics and data into one place so that we have real-time visibility into that. But nowadays, if I were to think about, if I were to start a new startup, right, I certainly partner with something like you guys, like Fuel Finance, to be able to build a holistic dashboard and have finance in just one single location, just right off the bat, that would have been a lifesaver.
Interesting, but like going back before this dashboard. So what was type of management? So even before like NetSuite and all this stuff, because I understand that like for early stage startups, NetSuite sometimes is not a good solution. Like sometimes I see that.
It's too big for an early stage startup. No.
No,
Even
not for
before
early
we were
stage.
using, yeah, like QuickBooks. Before then, we were using obviously good old spreadsheet. The problem with spreadsheets is it just makes it harder to collaborate as easily because it's not as structured. And unless you have a well designed like spreadsheet with right collaboration and roles and access permissions set up, like it'll get messy. Some people will is bound to make a mistake, and somebody will accidentally overwrite a cell. Then you have to go into version history to figure out who's made a change, roll back. It's a mess. So you want a little bit more structure than that. And then a lot of our internal tools were manually built using Python and just a bunch of like JavaScript, right? And it wasn't just good because obviously a lot of engineers who were tasked to do it, because when you're a small stage company, like you don't have like dedicated teams to build out internal tools. So these are like borrowed resources to build the tools, and then they go back to doing whatever they're doing. And oftentimes you'd have to ask them to come back and do make a little bit of improvements. And that upkeep creates a lot of confusion and communication cost for internal startups. So you obviously want to use whatever the best solutions out there to increase your productivity while being able to focus on what matters to your business the most.
Yeah, and it's like I totally agree that it's very complicated to connect all this data, even like in Google Spreadsheet and different files. So you often have these mistakes. Um, Taking into account what you have now, so as a CEO, what I don't know key figures, metrics you track, and how often you do this, and in comparison, for example, with your early stage when you was like I don't know, series seed or A series, like what metrics were important then, and what metrics are important now for you?
Yeah, I think what happens before pre-product market fit versus after product market fit starts to differ a little bit, because pre-product market fit, you don't know what success looks like, right? You're still trying to navigate the problem space, kind of going between divergence and convergence a little bit, trying to figure out what is the right product that you want to build and kind of sell to the market. So you may start with some North Star metric, could be users, could be signups, could be whatever, like website traffic, things like that. But a lot of like your early metrics might be wrong because it's very likely that you may have to go through some macro or micro level pivots. But once you find a product market fit, obviously having that kind of data driven culture is going to be super, super important. And then what's also interesting is that initially we try to use a couple of leading indicators as our North Star metric, because if you were to choose ARR, obviously it's going to be hugely lagging metric for an early stage company, because you haven't really built out a frictionless and a repeatable go-to-market motion yet. So my recommendation is first figure out what is the customer's journey look like, and what are some of the leading metrics that you want to track that you believe if this metric goes well, if the convergence goes well, then it will lead to positive business outcome. And as your business mature, you can pull that down a little bit towards the actual customer value metric, whether it be AR, whether it be usage or consumption volume. So kind of shifting that kind of North Star metric, that's probably at the very top level of the company OKR. Then you start to layer in department level or product level OKRs to support that growth, right? So if it was like usage, then what does the funnel look like for that usage? Then you're probably looking at signups, SDK installations, first app go live, first message, things like that. That tracks ultimately to the usage metric. So kind of think of OKR as an evolving kind of tool for you to navigate the direction of your company. Nowadays, obviously we measure at a company level, we share it quarterly or twice a quarter basis. But within the organization, per department, some department track their OKRs on a weekly basis, if not more frequently. Some of the leading indicators we actually track or check in twice a week. So we're a very high frequency data driven organization, and that this did not happen overnight. Some of the things it took us years to get there. Some of the things it was a relatively quick thing, but generally, I think it's just helpful to have some frameworks like OKRs or KPIs, whatever that fits your organizations, and just start building the muscle. Because that building the muscle will take time. It just, you cannot take that for granted. You need to actually really work towards building the muscle and cadence in the organization.
Yeah, for sure. And like you use OKRs, you don't use KPIs, yes, in your team.
We use OKRs, yeah.
Why did you choose to OKRs, not KPIs?
I mean, there are obviously good books on what OKR, how OKR is different from KPIs, but I generally like the concept of having stretch goals. I personally have been using personal OKRs for the past 17 years, I guess 15, 17
Oh,
years now. Every year, my ritual is to January 1st, I go to, let's say, a beach or some quiet coffee place and start thinking about what I want to do for this year. It could be December 31st or January 1st. But then I sit down and divide up the goals into quarterly basis. And I usually have 3 to 4 dimensions: personal, like social, work related, and then kind of like future humanity. It's like really kind of far out looking. So in each of those categories, I would have 3 to 5 goals that I track throughout the year, but also measure on a quarterly basis. But I updated them pretty much in real time. So I always have that on my screen. I carry them with me. So I've been building a practice. So I really enjoy being able to beat my number and actually go for the stretch goal. And I think there's an internal kind of motivation that that people share when they are not only hitting those numbers, but actually being able to be above and beyond. And there's that gratification you get from that. So it's like when you're in the gym, you can do 10, but if you push for 12, you get that extra strength, right?
yeah,
Extra.
like train yourself to do best, yes.
Yeah.
As you
So if you look at our core value too, second core value is called better than the best. So there's always
Mhm.
something better out there. There's always a better way to do certain things. It's the belief in the growth mindset. So I think the OKR has a good alignment with that growth mindset.
It's some type of like also planning part. So as I understand, so you have like this target plans, huge ambitious plans. So as OKRs, and you track. So you mentioned that you track in personal life also some type of plan actual to understand how you're going with this OKRs and your goals. In your company, you also have this part like plan actual analysis to understand, okay, how are you going, how all other executive team members going with this plan, so how do you achieve them. What is this type of planning in your company, and how is your management connected with this financial part? So I don't know, some meetings, things, strategic sessions, or like quarter reports, monthly reports.
Yeah, every week. So we hold our executive weekly stand up on Mondays. And then on the Monday, we start out with, obviously notices, like what are some big changes. But the very first agenda is what we call the thematical review. So thematical is basically a quantitative dashboard of the OKRs. Could be pipeline, could be whatever those things that matter most to us. And we as an executive team go through those numbers together. And if anything's falling behind, we can talk about how to improve it, why are the gaps are happening. So we kind of have this target numbers and we track the actuals on a weekly basis for the most important metrics. Now, we don't go through every single metric. We pick out what's the most thematically important goal for the quarter, and we track that on a weekly basis with our executive members. But also, we have a second layer of leadership groups, right? We have go-to-market leaders, we have product leaders, and by leaders, especially on the go-to-market side, obviously, we're looking at all the funnel metrics on a weekly basis. So we have a target number, actual number, and we also have a pace number. So based on the current pace, will we be able to hit the target or will we fall behind? So using that pace number as and then color coding it, right? Green, red if you're missing, green is like above the pace. So being able to know how we're tracking against our monthly goal and as well as the quarterly goal and towards the yearly goal, of course.
And you check this like on weekly basis, yes? Am I right? So for example, you have monthly goal for some metric, and
Mhm.
on weekly basis you track, so how are you going with this monthly goal? So what was your result for the previous week? Yes, what was planned, I don't know, for the next week? It's something like that.
Yeah. So we have a column of weekly metrics that we track, and we also have total, pace, and the target, and then that's on a monthly basis. And if you go to the quarterly column, we'll also have quarterly, actuals, quarterly pacing, quarterly targets, And then if you scroll all the way to the yearly column, we have a yearly actual, yearly pace, yearly target. And of course, not all quarters are even. Like B2B SaaS companies will have, either, certain quarters seasonality, whether it be backloading, front loading. So we'll have a different kind of fluctuation throughout the year, fluctuation throughout the quarter. But we also factor that in at our scale. We have a, pretty good high resolution of understanding of how our business is going to turn out to be.
How do you predict your revenue part? So do you, like, at your stage now, you already, like, I don't know, I heard somewhere like that you have already more than $20 million annual revenue, something like that. Like,
Yeah,
how do you?
we're far beyond 20 million, but
Very far.
yeah,
Sounds
thankfully.
great.
But yeah, I think how we do it is obviously there's multiple inputs, right? There's bottom up around teams, capacity modeling. If a salesperson has, $1 million in carrying quota, and then how many sales reps do we have, and we kind of do the carrying capacity modeling. But we also do forward, forecasting through our go-to-market model. So we, using our historical data, what we have created is basically if you put in, X dollars in marketing today, how much of that will go through the funnel at what stage throughout the year. So let's say if our sales cycle is, call it, a month or 3 months, then we know in the first month, the marketing will go through the top of the funnel. If it's like, call it 3 months, then the third month, it will turn into AR, right? So we have this like cascading model of how that marketing budget will move down through the funnel and turn into AR. And we have assumptions based on that using our historical data point. So with that, we can also use a model driven forecast / planning. And then we also look at our sales pipeline. So looking at our CRM data, and each of the sales reps, mark their likelihood, where in their process, we have weightings, average ACVs. So based on our current pipeline, we can also forecast using our sales cycles, how much of those pipeline will show up in AR. So we have this marketing model driven go-to-market model, sales pipeline driven model, and the capacity model, and we kind of, mush that in and then figure out what is the right plan and forecast. So sometimes, we may have a plan that's a little bit more aggressive than the forecast. Then we do the gap analysis and how are we going to bridge these gaps by pulling the deals into this quarter or creating net new pipeline through some other initiatives to fill those gaps.
Yeah, I think it's an important question, like especially when you told that you're a data-driven company. So for me, it's also about data-driven, that you have this data for previous periods, so you can use it like to build all these predictions.
Yeah.
Talking about your financial team and your CFO, did you remember when you hired your first CFO or financial team member? What was it period? What revenue did you have when you decided to hire this first financial person in your team?
Yeah, I don't know if we are the norm, but generally, from what I know, a lot of CFOs are brought on after maybe Series B, before it's like head of finance or just a staff accountant or someone like that. We hired our CFO almost right after our Series A. It was kind of like a good opportunity. There was a CFO that was available in the market. Our investor made an intro. Initially, I was like, "Oh, is the investor trying to like look into our financials? Like, what's going on?" But no, it's like
we should do something.
Thankfully, the same CFO is still with our company. He's been a great mentor to me, great partner, just a fantastic guy to work with, and just learned a lot as a human being. But with that said, we brought on our CFO, I think, a little bit earlier than a typical company would. But obviously, and then since then we have built, accounting teams and, I guess account receivable and things like that. So our team have evolved quite a lot since then. If I were to go back, if I hadn't met that specific individual, I probably normally company would hire again like a head of or director of finance kind of level, and then start building from there. Build the team, the accounting team, and things like that. But initially, there's a mix, right? Initially, in the very early stages, you'd outsource to some other third company that probably is like a moms and pop shop or some professional firm that deals with a lot of smaller startups and some laundromats and stuff like that. So then you start outsourcing to accountants who can do basically a bookkeeping. So whether it be cash basis or accrual basis, you have all those things mixed up. So you'll have to clean that up at one point. So there's a lot of messiness in the accounting and finance in the early days of most C-stage companies, because a lot of founder CEOs are not going to be CPAs. So we don't know what we're doing. Yeah. So we'll be
Somehow.
focusing on cash flow. We're like, how much do we have cash in the bank? How much do we spend? How much, and then is coming in, right? It's basically cash flow management. But we obviously have to evolve from that. Thankfully, because of my nature, I like numbers. Like spreadsheet is my meditation. So I like tracking numbers, and I think we built a pretty frugal culture in the early days where we were always very, very cost conscious. We almost
Mm.
had a fun figuring out good deals where we can buy monitors for a much cheaper discount on these ridiculous whatever websites, right? So that was our kind of like our jam. But I've also seen enough startup founders where they didn't manage the cash flow, and then they ended up almost shutting down the business multiple times because they didn't understand how the cash flow or the finance system worked. So in those, I think it comes down to kind of the coverage of the team. Does the team have the right DNA in them to kind of look at the numbers and be very detail oriented when it comes to finance? If they're not, I generally would recommend again using like Fuel Finance regardless, but they should also augment their team with someone who's a little bit more kind of metrics and numbers oriented.
Or just check your budgets and be really cost efficient, trying to understand how to manage your runway. It's really basic, I believe. But did you have some financial mistakes? You were like data
Ooh,
driven. I understand you're still data driven. You like Google spreadsheets, but what
yeah.
about financial mistakes?
Here's a funny mistake, and probably not a big enough of a mistake, but we formed our U.S. entity in 2014, late 2014, and I actually started working in 2015 in U.S. And because I came from Korea, didn't have knowledge of how U.S. finance systems worked. So I'm like, okay, 2015, let's spend money, let's do something. And then like a couple months later, we got this like huge bill from IRS, like, oh, you didn't file your taxes last year. Here's $10,000 fine. I'm like, what? If you pay $10,000, it will like run our company to the ground. We're running a very, very tight budget, tight ship back then. And I didn't know, like, I didn't know the US system back then. So I was like panicking. I was like contacting everyone. What do we do? It's like, no, it's your first time. A lot of people make the same mistake. Just write a letter to IRS. They'll waive off the penalty in the first year. I didn't know that. So like those were like some of the stupid mistakes. And again, in the early days, there's a lot of like mistakes around being kind of like gap, right? They understand the accrual basis versus like cash basis. A lot of founders, I still don't think I have the perfect knowledge, obviously, but don't really understand how that works. So we constantly get confused. So when we start communicating with investors, you may quickly lose any credibility in investors because you don't really know your numbers. And then without having a robust and a consistent way of tracking things, sometimes are like gap based, sometimes are not. So you got to clean that stuff up. So there was a couple of embarrassing moments during the fundraise where investors were asking me questions like, I thought I knew my numbers, but I only knew cash perspective. So
Yeah.
those are obviously all founder CEOs will have to learn eventually. But I wish I had something like Fuel Finance back in the days.
For sure, accrual basis, cash basis. I also hear very often from founders the most popular question, I believe.
Hmm.
Talking about this mistakes, what about this mistake? Like very popular when you first fundraise and after that you hire people and you understand that your runway is already too low. What is going on? Did you have such cases?
Yeah. Thankfully, I made almost like a similar. I avoided a mistake early on because this is my second company. I did my first company way back in late 2007, and immediately 2008 financial crisis hit. So nobody wanted to give us money. So we had to run on a very, very, very tight budget. We had multiple team members, and I think our entire annual budget for 4 people was like $50,000. So you can kind of imagine how little we were paying ourselves. So that kind of put us in the mindset of, okay, maybe there won't be help there won't be anyone to come and help us. So we kind of built that muscle, and then we ended up selling the first company, which was a good exit. And then with the second company, unfortunately, we actually did run out of money in the very early pre-Sendbird days. We pivoted into Sendbird, but while we were trying to become a U.S. company, because of some ridiculous investor, prevented us from doing a Delaware flip. So I had to basically keep the company afloat using my personal capital that I got from my first company. So we physically ran out of money, but thankfully, because of my luck from my first company, we were able to keep the company afloat and not miss a payroll. That's very important, to not miss a payroll. A lot of people get angry. So did that, and ever since we always never want to run out of money. And actually, during our application to Y Combinator, we were also running out of money. One of the first emails that I sent to Michael Seibel and Justin come back and was like, "Oh, we're very excited to join YC. By the way, we have like 3 months of runway left, and we just got a cease and desist letter from some other company. What do we do?" It's like, "I'll fire everyone." It's like, no, we can't. Like, I need, like, we do chat. I need iOS engineer, Android engineer. We need server engineer. Like, I just can't fire these people. Otherwise, we have no chat. So we ended up fundraising during YC, which back then was told not to do. Like nowadays, they actually like tell people, YC founders, to raise during YC. But back then, it was like, no, don't raise during YC, only raise during demo day. But if we had not raised during YC, we would have run out of money. So that was a scary moment. But ever since then, we are always like proactive in fundraising. So during seed days, when we were doing Series A, we're actually cash flow positive in a couple quarters. So we're like, okay, we'll do Series A. And ever since, we're always proactive in fundraising. So thankfully, since then, no, we didn't have those issues.
Talking about your current financial metrics, interesting to know. Do you use some benchmarks, or I don't know, do you compare, for example, your figures metrics with some bigger companies, or maybe you watch, like this presentations, strategic sessions of other companies? What metrics do they have? So, do you use it now?
Yeah, actually, I'm very happy with our current, current and lead investor, our board member. So Iconic Capital actually recently also published their this report. If you go to Iconic Capital's website, they start publishing some of these benchmark reports for Iconic's top, portfolio companies, and they have all the top line metrics, whether it be AR growth rate, AR per FT, gross margin, whatever the things are. So basically, all the B2B SaaS metrics, they have a glossary doc, which you can look at to figure out how they define their own metrics, because all kind of SaaS metrics can have a slightly different definition. So we want to get into nitty-gritty details of how they're actually calculating them. And they also provide benchmarks. So we actually use those benchmark numbers pretty a lot. So we have multiple benchmark data points from a lot of different investors, thankfully. But Iconic does a wonderful job of providing those benchmark numbers. I highly recommend all B2B company founders to go check them out. It's mostly useful if you are past $10 million in AR. So below that, because Iconic usually invests in companies that are, after those stages. Not always, but most cases. So because before you don't you have enough data points to kind of measure yourself against a benchmark.
Yes.
Yeah, but once you're past 10 million, you start to have some trends. So there's a lot of like metrics that you can use, like upsell versus new, and like sales cycles and stuff like that. So every quarter they publish a slightly different report, or every year. But we've been using that data point for the past couple of years since they led our Series B.
Cool. And in the end, as a CEO, as a Y Combinator alumni, as investor, what will be your recommendations in finance and financial management and overall management in the company for early stage startups?
Yeah, well, before even we go to finance, right? Maybe this comes from my personality, and this core value is to don't give up that easily. Just if you start your company, try to do it for the next 10 years. This is actually a good litmus test, because if you cannot see yourself doing this for the next 10 years, maybe you are doing something that you don't find a lot of meaning in. Maybe you're just trying to hop on a bandwagon or some trend. But find something that you want to work on that gives you personal, meaning, so that you can kind of, because like startup takes long and it's going to be a hard journey. But once you've done that, making sure that you don't die while you do it, physically, but also financially, right? Sadly, the statistics are not favorable to founders. Founders do physically die more than other people. But I'm talking more financially.
Good point in the end.
Hey, speak the facts. But I think was it Bill Gates or someone said the best, or maybe Jack Welch, like you just gotta manage three things, right? One is customer happiness. Two is like I like to paraphrase it as employee engagement. Three is cash flow. So don't run out of money. Companies die from two reasons, right? Running out of money or running out of morale. So you have to make sure that you don't run out of money, and then also manage the morale of the company so that you can continue to execute. So yeah, from financial perspective, just don't run out of money, then you'll have opportunities.
Sure. Thank you so much, John, for this conversation, and hope that all our listeners will not die because of running out of money and will build unicorns.
Stay
Thank you
alive.
so much. Thank you so much.
Yep.